Hi everyone. Welcome to Vesta Equity's Real Equity podcast. We'll explore the evolving world of blockchain technology and the impact that the digitization of real-world assets like real estate will have on the macroeconomy, but also the wallets of everyday consumers. Will blockchain fulfill the promise to break down barriers and democratize wealth creation for all? Join us on the journey ahead as we help you navigate the risks and opportunities in building what we like to refer to as your wealth stack. Enjoy today's show. Why tokenization is the future of real estate investing.
Hello and welcome everyone to Vesta Equity's podcast. We genuinely appreciate the time all of you are taking to listen in. This episode is focused on why tokenization is the future of real estate investing. So, a little bit about me. I'm Brittany Campbell Turner. I am the CEO of BuilderChain and Constructor. BuilderChain is focused on having faster payments using tokenization in the construction industry. Constructor is focused on bringing people along using technology, supporting the relationship building within construction, and doing technology consulting. With that, I'm going to go ahead and make sure you know who's on our panel. We're looking forward to a healthy discussion and debate on the issues from these experts, and we have an esteemed group of panelists participating. Andrew Baum, Don Friedman, Paul Dubé, and Michael Carpentier. Let's start off with a quick intro from each of you. Let's start with you, Andrew Baum.
Hi, Brittany. Thank you very much, and thanks for being invited onto this panel. So my name's Andrew Baum. I'm a chairman of a real estate fund management business in London called Newcore Capital. I certainly would put my hand up and say I'm a traditional real estate guy, a charter surveyor, CFA, been a fund manager for 20 or 30 years, and I've also got an academic appointment. I'm a professor at Oxford University Side Business School, and I've done some research on tokenization as part of our work on the future of real estate, and I'm happy to share our insights with you.
Great. Don?
Hi there, I'm Don Friedman, president of the Digital Assets Council of Financial Professionals. We're founded by Rick Edelman, who's the founder of the nation's largest RIA. And what we do is we educate financial professionals on blockchain and digital assets through two primary means. One, we have a certificate in blockchain and digital assets online course, which is now a designation. And then we also educate financial professionals through events.
Paul?
Thanks, Brittany. I'm a co-founder of Troon Technologies. We're an enterprise software development company distributed globally. And so our focus is on health tech and Web3. Been in this space for, about 7 years in Web3, since it's the focus of today. I think at the heart of it, though, I'm an entrepreneur with a background in tech and business. So I have a strong desire to problem solve. Specifically in this space, there's a lot of challenges. We won't call them problems to solve, but a lot of challenges. So I do appreciate the opportunity to be on the podcast today with a great group of gentlemen and a lovely lady orchestrating the reins for us. So thank you.
Thanks, Paul. Michael?
I'm Michael Carpentier. I'm co-founder and CEO of Vesta Equity. I've been hooked in digital technology ever since I got my first Apple IIe, which dates me a bit, but that's how long and how far back it goes. With Vesta Equity, what we want to do is we want to tokenize millions of homes across the globe and provide people access to their equity debt-free, while also providing investors the opportunity to invest in those assets directly. We want to create the world's largest marketplace for home equity, and that's really the purpose and drive behind Vesta Equity and why we created it and built it out, is to help people and democratize wealth.
Great. Now that we have everyone introduced, I'm going to roll right into the questions. First one who's up is Andrew. Andrew, how do you anticipate tokenized residential home equity investments will reshape the traditional real estate market? And what specific benefits will they bring to both investors and homeowners?
Okay, Brittany. So I'm going to slightly evade the question, if you like. First of all, I'm going to say I'm not convinced that it will. I'm not convinced that tokenization will revolutionize home ownership. And that it rather depends on the approach, the specific approach that's taken here. So when I see a tech innovation, any tech-based innovation, the question I ask is, what is the problem that's being solved? With blockchain applications and digital assets, tokenization generally, there's always a danger that the technology solution is so beautiful that it clouds everybody's understanding of what problem is actually being solved. So my question is going to be, what is the problem that we're solving here? Now, I've got one. There's one problem which is being beautifully solved by Vesta Equity and others, and that is the equity release side of this. I can think of so many use cases where somebody owns a property and wants to take cash out of it without taking on debt or selling part of it off. And equity release is a beautiful solution to that. Traditional solutions to equity release have always been clunky. They haven't been trusted. There's always suspicion about too many fees being taken out. Therefore, it's just not as popular as it should be. And it really is happy to talk about why it's such a great thing. The problem on the other side, though, is this sort of presumption that we should democratize home ownership, and the idea that presumably younger people without access to homes should be allowed or encouraged even to buy a small piece of a house. And that's the bit that I'm worried about. I don't think that's a problem which is being solved. The problem is that people can't buy 100% of a house and be part of the owner occupation market. I don't see a huge queue of people wanting to buy $1,000 in my house. I just don't get that. And it doesn't mean that this won't work. It just means that we have to be very specific about what problem we're solving here. And I'll talk in the next chance I get, Brittany, I'll talk a bit more about the difference between getting small investors into an individual house and other ways of getting capital into this market, which I'm happy to go on about more.
Sure. Any initial responses to that from the panelists?
Well, my initial response is, why don't you think that somebody would be interested in buying $1,000 in a house if that's, what they can afford?
Okay, well, maybe they will be interested. I'm not sure that they should be interested. Is really my point. This presumption that housing prices are a one-way bet and that you're going to get rich by putting $1,000 into a house is clearly not true. That we've been on this long run of upward house prices and shortages of houses for a while, but I would never encourage my 3 kids to put £1,000 into a single house. It would be a crazy investment. Markovits said there's only one free lunch in investing, and that's diversification. So, you should get the benefits of diversification. That's the first thing. So I'd much rather put $1,000 into a US REIT that invests in, multifamily housing than put my money into one house. That's the first thing. And the second thing is the lemon problem. How do I choose which house to buy? I've seen some really good tech startups that use clubs of MBA students with some knowledge of a particular market, let's say Chapel Hill, North Carolina, where somebody's worked for a residential developer, they've got some insight, they think they know the town. You put 10 people together to share the equity of some of the house. That makes some sense to me because you're avoiding the lemon problem. But this idea that you can democratize home ownership across a large pool of retail investors who can choose a house to invest in, that worries me a little bit. And that, all of the investment regulations are set up to protect retail investors for good reason, for a very good reason. So, I'm sure we'll be talking about the tension between democratizing and investor protection at some point. And, we have to get into that, I think.
Yeah, I don't think we're far off. We obviously support MPT, and this is a way for anybody who believes in diversification to kind of gather real estate as an asset class. To your point, people can do REITs. To your point, people can be in these investor clubs. But I think there's also, from a self-directed standpoint, and I support what you're saying in terms of protecting investors. Obviously, we're huge believers that everyone or most people should have a financial advisor. But if you live in a town, and to your point, in terms of the due diligence and really knowing the area, knowing the business area, the residential, I think there's a possibility, and nobody's perfect, that they will actually know their neighborhood probably better than a professional manager, et cetera. And again, I think it's less about the dollar figure of $1,000 and more about, let's say you want to allocate 1% of your portfolio to real estate, whatever that number is. and you know the town, the environment, the business, everything in that area, that it potentially could be a good opportunity. To your point about a real estate market that just forever goes up, agreed. I mean, I think that's obviously history shows that's unrealistic, but potentially there's the opportunity to dollar cost average in as well. And also, hold for the long term, buy and hold.
Sure. Now, someone who knows a little bit about construction understands the lemon issue that you were talking through, Andrew. And to be honest, Don, you've somewhat touched on the question that I was about to ask you, but I'll ask it anyway to see if you have any additional context here. So real estate tokenization is often praised for its potential to democratize investments. Give us examples of how real estate investors can effectively navigate this new landscape.
Yeah, so you're exactly right. It kind of was an easy segue right into my question here, which is we also, we oftentimes look at it from the standpoint of the financial advisor advising the client. And so what happens is as clients get older, they retire. And when they retire, they need income for their retirement. And their house is usually, if not they're one of their biggest assets, the biggest asset, and it doesn't produce income. They don't want to sell their house. They don't want to do a reverse mortgage. So it's like, what do you do in that situation? And that's where we feel you could tokenize your house. So you take $1 million house and you sell 1 million tokens for $1 each, and now you're generating income. And we feel, as we just kind of touched on, that investors will want to buy those tokens because they're familiar with the neighborhood, they're familiar with the house, and they see that this is an opportunity that they feel that buy and hold or medium term, however it is, that they feel that there's an opportunity to make money from that investment. And then as the owner, you can actually buy back those tokens in the future if you want. So what it does is it provides this income stream, even more particularly for those that are either entering retirement or are in retirement.
Great, from an investor perspective. Thank you. All right, Paul, the next question is for you. Blockchain technology.
Brittany, I'm sorry to interrupt you.
Did you have something, Andrew?
I demand the right of cross-examination. Yeah. My question for Don was, sorry, how exactly does the homeowner get an income? I can see how they get capital by selling a token.
When they sell the tokens, they're receiving the income from those tokens. It's think of it like a stock. I mean, they sell the token to that person, and they get that money, and then they can off ramp it into fiat if they want.
Okay, so they're raising capital basically. They're not generating dividends. They're generating capital by.
That's right.
Okay. Yeah. Thank you.
Yeah. Thanks for the clarification. That's a great question, Andrew. Appreciate it. Paul, back to the blockchain question. Blockchain technology is at the core of real estate tokenization. For those of us who do not know, could you shed light on how blockchain enhances transparency, reduces fraud, establishes trust in real estate transactions, and ultimately could revolutionize the industry?
It seems boring to answer this question after listening to the back and forth there, because I'm so interested in the financial side of it as well. But sure, there's a lot of core tenets to satisfy transparency and reduce the fraud. And they start with on-chain transactions themselves, and they're verifiable, they're permanent between two parties in a decentralized network. I have a lot of marketing people in my life who are like, we got to just stop talking about the blockchain. But the reality is, to simplify the statement of verifiable and blockchain and all these difficult words to absorb for a lot of business people, it just crowdsources the auditor function in a distributed ledger. So I don't remember where I read that years ago, but that's effectively what the blockchain does. Nothing is centralized. It's a bunch of computer validators, if you will, that are replacing financial auditors to ensure the integrity of the transaction on a distributed ledger. So that would start there. I guess with revolutionizing the industry, I think we're just getting started. I think there's a lot of creativity in the space. Perhaps it lacks a little bit of education, but the creativity, obviously Vesta Equities has done a great job with this by tokenizing property. And we just had this great balanced debate a minute ago. But I do believe that it enhances transparency, trust. I think it unlocks liquidity in P2P marketplaces. So I think we're really just hitting the ground early right now and defining these new market opportunities for investors and buyers. But I think a lot of it comes down to education and redefining what ownership means to own a digital asset in this space and earn yields from it, and all the rest of the cool applications that are out there that help earn more revenue streams from it.
Thank you, Paul.
Yeah.
Michael.
Yep.
Why are tokenized home equity investments a solid asset to your investment portfolio?
Well, let's go to the diversification issue, which Don brought up. I think it's important to have a diversified portfolio, a balanced portfolio, if we want to call it that. And real estate traditionally can play that role. It's the type of asset class has stability. It's got a good risk return profile. Yeah, it's not always on an upward trajectory, but if you look at over an extended period of time, it does appreciate in value. Plus, we've built in functions and features into our product where the homeowner can give up additional equity in terms of a dividend or a premium to sort of accentuate that sort of return on investment that the investor is looking at. One of the nice things too is that with what we're doing is that we enable people to buy small lots. They could buy as little as $30 if they wanted to, or more. But the point of that too is to do what we call geographical diversification. Not all markets, perform the same at specific points in time. So it enables you to diversify across various areas across the United States, globally, and so on and so forth, and then eventually across property types as well. So those are things that I think are important. And if you look at it on a spectrum of risk benefit and return, if you look at sticking your money under your mattress, that's probably the lowest risk thing. Although one would argue there's risk because you're not getting any return on your investment, but it's going to stay there. You're sticking it essentially in a safe. It's safe in that regard. Two, sort of investing in high risk exploration for new minerals and stuff like that. The return could be great if they strike gold, but there's a chance they won't. So we're trying to put the product in a 7 to 10% range in terms of return on investment. In some cases, it may be higher based on specific markets that are performing extraordinarily well. But I think that's one of the fundamental reasons why it's a good thing to add into your portfolio. It's solid. It won't disappear tomorrow. It's not a cryptocurrency. It's not an equity at a high risk company that could disappear tomorrow and go bankrupt. The asset will remain, and you're pretty well assured over time it will appreciate in value. It is a limited resource, and we do deal with supply issues, and those supply issues are continuing. And until we are managing to actually meet the demand of what people have for homes in Western democracies right now, it's a serious problem. We just can't meet the demand, and as long as that is a situation, the supply is not there, prices will continue to rise.
Any other responses to that question?
Come on, Andrew.
Well, I'm waiting for my second question because it sort of it will address a lot of those things. I mean, I like the idea. It's a great idea in principle. I mean, I think we're going to move on to the practical challenges, which is what it's all about, really. That nobody could argue with the idealism of democratizing the real estate market. Nobody can argue with the supply-demand imbalance. We are short of homes, and therefore they probably do have a really good risk return profile in the long run. And US homes have outperformed equities over 150 years just by a margin, as far as I understand it. So there are all sorts of reasons why this looks like a good thing. I've said what my challenges are, but I want to go on to my next question, Brittany, really to talk about the practical challenges.
Let's get into it. So,
Okay.
What are the primary challenges you foresee in the widespread adoption of real estate tokenization? How can industry stakeholders collaborate to surmount these challenges, all while upholding market security and stability?
That's the key question, in all of this. And if I were a young go-getter like Michael, I'd be completely motivated to solve all these problems. The problems are two, right? So on the one side, one problem is the cost of customer acquisition. So if you are looking to raise money from the retail market, from individuals, then the cost of customer acquisition could be huge. It's very, very, you need a very, very big capital raise to be able to bear the cost of promoting the brand of the business to the point where you've got enough people buying $30 worth of a house at a time to buy enough houses to make this significant. So that's the first thing, and that's the business challenge. The second problem, and the problem for investors, the key problem for investors is how do they get their money back? So where is the secondary market? And the real estate market is, the highway to change in the real estate market is strewn with damaged vehicles on the side of the road, that have tried to do something like this in the past. Only this month, IPSX, a London stock exchange for units in individual buildings, failed, having had 30 million of investment into it, that's gone. And the key reason was because not enough buildings were put on the platform, and not enough buildings put on the platform because there was no evidence of any secondary trading. There was no particular exit for anybody. And that's a key problem. So if I buy $30 worth of a house in Chapel Hill, I want to know who's going to buy that from me for $40, seamlessly with very little friction, with no transaction costs. That's what I really want. I want to buy in on my phone. I want to sell out on my phone. And the selling out bit is the key problem. So the investment market is very clear about the distinction between retail investors and institutional investors, and the traditional world of investing is damaged, if you like, or undemocratized by the need for institutional solutions. Institutional solutions exist because they aggregate capital, and they should be efficient ways of providing secondary markets. That's what they're about. So the solution to this problem, I think, is to create a huge investment pool, probably a big REIT, which is on the other side of the transaction. And if there were one or two big REITs that just wanted to buy units in existing equity in houses, then that would be an institutional solution that could sit alongside the retail solution. But it means that the buyer of the $30 unit knows that there's a Fidelity product out there that will take out their $35 at some point, frictionless, because there's this huge pool of capital that wants to take it out. And that's the key issue as far as I can see. I'm happy to go on about it, but it's I hope it's clear.
I see Don, go ahead.
Just in terms of your first point, in terms of cost of acquisition, it's a question, not a statement. In terms of where real estate agents now currently have various ways in which they specialize or differentiate themselves from a marketing perspective. Do you think that there'll come a time where somebody will see this whole tokenization process and figure, here's a way I can differentiate myself and focus on that market in order to develop a niche which differentiates themselves, which allows them somehow, I'm sure they'll figure out a way to collect a fee out of, pulling together 100 investors or however it is. But do you think that that's something that could happen, likely to happen? If so, when do you think it would happen?
Yeah, I suspect that real estate, that realtors or estate agents, as we call them in the UK, are going to be the last people to jump on this particular bandwagon. I suspect they're going to be, they're likely to be disintermediated by securities people who understand blockchain and tokens, and this will be seen as which is a danger. This is a challenge for your initiative of tokenizing real estate. The traditional real estate brokerage channels are likely to be resistant to this, and that's a problem. You've got to bring them in at some point. But my solution is you bring in Blackstone or Fidelity or Prudential, as the buyers of these products, because they have such a natural appetite for exposure to residential property in a reasonably liquid securitized market. They are the natural buyers of this, and no reason why retail investors can't sit alongside it if the costs of accessing the market are low enough. The big problem for retail investors getting into real estate is that often the big fund managers just don't want them. They're too expensive to take on as investors, and it would be great to solve that problem, but there just aren't enough of them. There isn't just not enough money to create the secondary market pool that you need. Therefore, you need some big animals in there who will provide that exit, I think.
But you actually bring up a good point where I was touching on real estate brokers. Financial advisors are the gatekeepers also. I mean, think about like they see, we work with asset managers all the time where they want to get in front of advisors because the advisor is the gatekeeper. So if you convince the advisor who might have 100, 200, 500,000 clients, if you convince him or her of an investment opportunity, that then now goes down to all their clients. So that could also be another avenue in terms of having a tokenized market work in a residential.
Yeah, I'm with you there, Don, and I'm sorry to dominate this, but just one point. I think we need to get very clear in our heads whether the sell to the individual investor is like an inferior form of getting on the housing ladder, as we constantly talk about in the UK, or whether it's a pure investment that you would sit alongside your investment in Apple shares and crypto, and that the second one works for me. The first one clearly doesn't work. If you think this is your way of getting into the housing market because you haven't got anywhere to live, then this ain't going to work. It just isn't going to work. So we've got to be very clear about what the proposition is to these investors. And
as an investment.
Yeah, and what we call IFAs in the UK, what do you call them, Don? Your financial advisors.
Right.
So anyway, yeah. So they are important. I agree. They're important as a conduit to market. Yeah.
Yeah, and I agree the institutions need to play a role in this. I mean, one of the areas we've also identified are pension funds. Pension funds can both be a source of purchasing these assets because they fit well with their investment profile or their investment thesis, but they also represent pension holders. And oftentimes those pension holders will need to access the equity in our home. So we see pension funds definitely as a source of purchase and potential supply as well into the marketplace. From that perspective. So I agree, it has to be both institutional. They have to sit alongside each other. Institutional and retail investors have to sit alongside each other in this marketplace.
I think if we roll back a second, and somebody had mentioned some of the realtors and the private offices. I was involved with some conversations with global angles and Volkers, and they were seeing the opportunity to be involved with platforms like Vesta Equity and actually own some of that and get some of the revenue kickback from those platforms as well. Well, the consideration of running DAOs, I know we're not going to talk about DAOs, but decentralized autonomous organizations and things of that level. But there's a lot of conversation. I'll be careful what I say, a lot of conversation. I've been involved with a fair bit of conversation in several different countries about this. So it's on their radar, and they do need to get involved to help to push the industry forward.
Yeah, we got to remember too, there's still going to be off-chain sales of assets, right? Homes. People are still going to want to move. I don't think we're necessarily going to see a big shift. The average home in the US sells every 8 years. So I don't think we're necessarily shift there. So there is that liquidity that does naturally exist where investors will be exited at that point, and will be able to get the return on investment after an 8-year period as well. So there's still that will still exist. And what role real estate brokers play in this and the final analysis as we move down the road is hard to predict, but they potentially could have a role sitting alongside financial advisors potentially. I don't know, but that's definitely one of those question marks. And let's face it, segments of industries get disintermediated out of the marketplace because technology develops, and that's just the reality. And we won't get into AI too much today, but AI has the potential to do that as well, disintermediate a lot of people out of the workforce. Sure. For an interim period, hopefully.
Paul, I appreciate your reference to the global market, particularly where there are underbanked and unbanked individuals. I think that there's a huge opportunity, personally, for investments in areas where there's not a lot of industrialization, where in the Western market it's going to be completely different. So that said, we've been having a lot of conversation in regards to diversification, and we'll continue it here with my next question to Don. Diversification is a fundamental principle of investing. How does real estate tokenization expand diversification opportunities, and what role does risk management play in this context, especially considering the evolving nature of tokenized assets?
Right, great question. So I think that the biggest thing to point out here is the global real estate market is 3 times bigger than the stock market, the global stock market. And the reality is real estate is expensive. It's illiquid, but not when you tokenize it. So what we do is we create liquidity for what was an illiquid asset. So the way to understand this is think about, as I touched on earlier, how shares are to stocks, tokens are to real estate. So we will demonetize it and we will democratize it, allowing people another avenue to add real estate to their portfolios. And like I said earlier, when we talked about MPT, the more assets you have in a portfolio, you're going to end up lowering your overall risk as well as increasing the likelihood of higher returns.
Any responses to that? Go ahead, Michael.
No, I don't. I agree. I agree 100%.
All right.
Agree over here as well.
All right. I don't see one other hand being raised, but that's okay. We'll keep
waiting for Andrew.
The theory is absolutely right. I've got no argument with the theory. No.
Well, there's the practicality of all these theories, right? And that takes time, and you build it and you learn, and you build it and learn, you dismantle, rebuild, and we've definitely.
As you well know, Michael, the devil's in the detail here. How do you structure these investments? If I buy a percentage of a home, do I get a rental income from it? And if I don't get a rental income from it, why would I do it? Why wouldn't I simply buy a commercial, a property REIT, which gives me a dividend and a share of capital appreciation as well? So the product has to be structured in a way that makes it attractive to investors somehow, which means some sort of artificial structuring, doesn't it, in order to either give them more equity than they're buying, or to give them some sort of equity staircase, or to give them some sort of phantom income. Is that the way it works?
Well, we built in, as I mentioned to you, we've got what we refer to as an equity dividend and equity premium to up the return on investment that an investor will get from the homeowner. Now, that's specific to non-income residential properties. We do intend to move into income properties as well. Probably our first foray will be into vacation income properties, because we found through our own research they tend to keep their appreciation higher than a typical income property, which tend to be lower because they're built for high turnover and not necessarily built to the best quality to begin with. But and they're also reviewed on a regular basis, the quality of the asset in terms of the vacation users. So we will probably move into that space, and then eventually move into income properties as well. And in that case, they'll get a dividend, which would be, an annual fee that they would return based on the income of the property, or a monthly. We still have to determine that on both either an income property or vacation property.
Yeah. By the way, Brittany's point about emerging markets, developing markets, I think is a really good point. I think if you want to make progress with this in Africa, you might make progress with it in Nigeria, Kenya, places like that. There's such a natural absence of alternatives, and such an obvious case for this that I can see that in a developing market. Absolutely.
Not necessarily for this call, but we talk about exactly that: the unbanked or the underbanked, or not being close to a bank, just in digital assets in general, not necessarily specific to real estate. But that's for another webinar.
Yeah. I think if you had a portfolio and you own a bunch of different assets and you're in those countries, oddly, it can bring a lot of credibility to yourself as well. Sharing that, it's a whole other subject, but I think that it could be pretty powerful.
Yeah. It's one of the reasons why we're launching a mobile app for investors over the next few weeks, to do just that, to be able to provide access in markets where they're using their phones more readily than they use an iPad or a laptop, and they can access this marketplace. And I think that's one of the cool things about this too, to be able to do that.
Well, speaking about access to technology, let's continue on with the next question here. Scalability and user experience are paramount in any technology-driven solution. From a technological standpoint, how can real estate tokenization platforms ensure smooth user interactions while handling a potentially large number of transactions? And that's for you, Paul.
Yeah, so there's a lot of questions in there. I guess I'll tackle scalability first. And I think this might not be a popular opinion, but scalability at the protocol level is is just an ongoing imperfect art. And for me, it's largely untested at a real intense production state. That's at the blockchain level. We've got like 300 protocols, not enough usable dApps. But if we streamline to what Vesta is doing, as an example, Algorand themselves, I think have done a brilliant job at continuing to upgrade, ensure their speed and scalability. I think they're 3 point some seconds per block or something like that. I read last week.
Yeah.
So they're very strong technicians. We all know, they've got a great foundation there. Vesta has brilliantly simple user experience, and I really admire the work that you guys have done there, because I think it's really hard. As I said, there's very little real good user experiences in some of these dApps, or just usable dApps in general. So I think scalability in relation to the dApp itself is just using some traditional server infrastructure and techniques, content delivery networks, and all kinds of other things that you can provide a better user experience. But the protocol level, I think it's an imperfect art right now, and I think that's part of the beauty of it and part of the challenge of it at the same time. Tackling user interactions, like this one is a big one for me. And again, congrats to you guys. But I think to address tokenized real estate and smooth interactions, it really depends on what use case you're tackling in your app or your dApp. Whatever you're trying to solve and validate. And there's various techniques that are out in the market that range from probably less blockchain 3.0 or web 3.0 and more 2.5. So we have walletless onboarding. I think this is a great part about technicians. We just try to solve stuff all the time, and it's hard to communicate that back up to business people to see the value proposition there. But walletless onboarding is happening today. It's integrating with things like Magic Link. Account abstraction uses smart contracts, which is sort of the big narrative going on in the EVM space right now, so that your application and your business needs can utilize things like multi-signatures and around sensitive transactions. Mixed custodial solutions are incredible. I think they're a really, really easy way to get involved, where you effectively can take your private keys at any point, but your entry point into this mixed custodial solution with a wallet is literally you get in there. They're combined with meta transactions. So you can download a wallet, super, super easy. You don't have full control of the keys, but in the app, you can take control of them at any time. So I think it's part of a mixture of educating people once they come in. All of a sudden they own this asset. And through a meta transaction, which means they could purchase with a credit card, fiat, or crypto, whatever they want. That's abstracted away. The native token is abstracted away from them. So really, they're just using a normal app like they do on an everyday basis. It's the job of the company like Vesta to educate people. Hey, you can take these keys whenever you want. And so, those are several techniques that we've employed. We've built dApps around them. We have our own digital asset application called Bloomly that we've done that with as well. And I think that this is going to be the advancement of hopefully a lot more adoption in the space. We have to move through 2.0 to 3.0 and use everything in between.
Yeah, you keep hitting the topic of education home, and I appreciate you doing that, because it's nothing like using technology that's seamless and has a great user interaction capability, but you really have to know what you're doing. So thanks for calling that out multiple times. I don't know that anybody would disagree with that particular comment. Did anybody else have any other comments to chime in about?
Just to that point is you've got to get people more comfortable with blockchain. You've got to make it more ubiquitous. It's got to be running in the background. You can't make a big deal about the technology per se. It's like, I don't care about the technology in my phone. I just know my iPhone works phenomenally well. The camera is unbelievable, and I can do all sorts of cool, nifty things with it. We got to make sure that we don't, as people in the early stages of this adoption of this technology, get too hung up on talking about the technology. Someone should be able to come to your website and use the tools and other functions and features without really caring that it's based on blockchain. And we tried to do that with what we built out, is to make sure that we didn't make a big deal too much about the technology. Obviously, it's there in our FAQs and stuff like that. People want to dig down deep into it, but I think at the end of the day, like any new technology, we got to make it simple and easy for people to use, and then provide all the educational resources for them if they want to dig deeper, because that's important to people as well.
I think that's exactly right, and I think that's the future. It's essentially the plumbing or the blockchain behind the scenes. People won't even. It'll be run on blockchain, and they won't even have any idea. And somebody will have to tell them, "Hey, you realize that this is blockchain enabled?" Oh, I didn't know that. You know what? Because everything's working fine.
Yeah,
Yep.
exactly.
All right, I have a next question here for you, Michael. What measures have you put in place to ensure the security and transparency of tokenization, especially considering the sensitivity of real estate transactions? How do you protect both homeowners and investors from potential risks or fraud?
Yeah, so it's a great question, because there is a lot involved in a real estate transaction, and the fact that we're tokenizing stuff doesn't solve some of those problems. And to Andrew's issue about the lemon issue as well, we try to address that and try and ensure that people are not getting a lemon per se. So how the whole process starts off with is everyone has to go through KYC, AML. We have to make sure we know who they are. From both an investor perspective and a homeowner perspective, both go through that process. With the homeowner, given the fact that they're the owner of that asset, they then have to go through a title search. We make sure that there's nothing nefarious on title or odd. We have helped a few people discover a few liens on their properties they weren't aware of, which can happen. But we want to make sure the title's clean. And the whole equity sharing agreement that we've built out, that sort of builds in the guarantees, for lack of a better word, for the investor and homeowner, are built into that equity sharing agreement. So as an example of that, a homeowner has to maintain the taxes, they have to maintain their insurance, and they also have to maintain, for their maintenance. They have to make sure the property is being upkept. And if they don't do that, we do have a clause in the agreement that they, at time of sale, if the house is below market value because they have not maintained it, and we use general data for homes in the direct vicinity, they have to make up the difference, which is why a percentage of the home can never be tokenized and put on marketplace. They have to make it up to the investor. So the investor's not out of pocket for negligence on behalf of the homeowner. And that to us is something important. And we're not mitigating all risks. If there was some sudden collapse in the whole entire real estate market, like every investment, you're gonna suffer. We all suffer when those things happen. What we try to do is mitigate those human risks through things like negligence or items like that. From a fraud perspective, again, it's on chain. So every transaction is verified, it's immutable, can't be altered, and it's there for everyone to see. So from that perspective, it's all on chain. So fraud from that perspective is obviously mitigated. We do what we can do, obviously, on the people side through the KYC AML process to make sure people are legitimate and they are who they are, in order to be able to allow them to do transactions online. Again, with the whole wallet issue, we deploy and employ all the security measures that can possibly be leveraged in that regard to ensure there's no fraud and no hacking of individual wallets. But again, if someone is irresponsible, their wallet could get hacked if they give up their keys to someone unwittingly. But the nice thing about blockchain is that it ends there. Getting keys to access to someone's wallet doesn't give you access to everything on the platform. All you do is have access to that particular wallet, and that's it. It stops there. So we do everything we can within reasonable measures to ensure that there's no fraudulent behavior on part of homeowners or investors, and we leverage the technology to the extent that we possibly can to ensure those factors as well.
Great.
Off topic question: did you need a VASP license? Do you need a virtual asset, digital asset license for that?
That's a good question. I'm the wrong guy. if Andrew were here, Andrew were here, you could ask him that. Andrew Bull. Yeah, no, it's a good question. I'm not the right guy to answer that. And to Andrew's point, Andrew Baum's point too about the lemon thing, we send inspectors in. That's another thing we do. Every home is inspected. There's no way around that. Your home has to be inspected. Photographs are taken. Then we verify the asset price through third parties. That asset price is verified. Homeowner and eventually investors agree on that base asset price. Those asset prices are updated on a regular basis. And to get a bit of AI in there, we are looking at deploying AI to better build better forecasting models for these homes as well, because oftentimes real estate data is always looking backwards. We want to also look forward at current data or data that's coming down the pipe. If we know that a particular geography is going to benefit from Boeing moving into the marketplace and home prices, home supply is not going to increase to meet that demand, then you're suddenly going to have an increase in home prices. And that's the type of sort of micro analysis we want to be able to provide people in specific areas. And that's where AI can be a powerful tool.
Yeah, as an AI consultant, I think that's a great opportunity for generative AI.
Yeah.
You have too much data in order to not be able to forecast that kind of information. So
Yeah.
yeah, that's awesome that you guys are doing that. Um, let's keep it moving. Let's get to Andrew's next question here. From an investor's standpoint, what are the key advantages of opting for tokenized real estate investments over traditional real estate options, particularly in terms of factors like liquidity and flexibility?
I think the first thing I'd like to say is that the traditional real estate investment industry is really pretty bad at allowing access into the products and exiting the products too. So we do have a fundamental problem in allowing particularly retail investors into property funds. You know, we have very high minimum investment levels. We have very, very inefficient KYC processes. We don't actually want small investors in our products because the cost of maintaining those relationships is too high compared to the fees that we're earning. So it's not a great industry in terms of liquidity, and exits are also incredibly clunky. There is no great exit from a non-listed real estate product of any sort, unless the only answer really is to be in a big REIT where you can sell your shares on the stock exchange. If you can't do that, then you're going to be trapped at some point by the clunkiness of this industry. I constantly complain that the shop I'm sitting in now, which I'm chairman of, I'm constantly complaining to my team that my investments in our own funds, I can't actually find out what my current value is. I have to send an email to the business development team, and they have to go in and look at the records, and then they send me an answer 3 days later. This is crazy. This is absolutely ridiculous. It all needs revolutionizing. There's no doubt about that at all. I mean, I would really like to see a blockchain-enabled solution applied at the institutional level first. So one of my worries is that we stigmatize blockchain and tokenization by applying it to the wrong products, and giving this sort of crypto mystique that it shouldn't have. It's just an administrative process, as I think Michael and Don have both been saying, and Paul. It's just a piece of engineering. So I'd love to see it used for. I'd love to see Blackstone come out and say, right, we are now tokenizing our big real estate fund. You can trade tokens in our fund digitally on a platform, on an app, and so. From Michael Carpentier's challenge is going to be to create the secondary market where people do want to trade these units backwards and forwards. And, somebody's going to have to create that big platform that works. And, if it uses blockchain, great. I mean, it's just got to be better than it currently is, because it currently is not very good. And I've expressed all my concerns about lemons and lack of diversification and so on. But there is a fundamental problem in creating liquidity in the property market. There's no doubt.
I'm excited to tackle this one with my last question.
All right. All right, let's get Don in here. It's somewhat related to some of the comments Andrew spoke about. Don, why is the adoption of blockchain technology and digital assets critically important for investors in the financial services ecosystem?
Well, I would start with that. JP Morgan Chase says the blockchain is going to save banks $120 billion a year. Blockchain technology lets businesses operate faster, cheaper, safer, and with greater transparency and inclusion. It eliminates the trust economy and creates the authentication industry, which is massive. We've kind of touched on this throughout this webinar. And as this webinar is about real estate, Think about all the intermediaries involved in a real estate transaction, from the real estate broker to the mortgage broker to the title settlement company. The blockchain can automate their services away.
Yeah.
And this is not just limited to real estate. There's intermediaries in various industries: stockbrokers, commercial bankers, lawyers, insurance agents. We're talking 10 million US workers. That's 21% of GDP. And it can all be digitized away by the blockchain. So where people have been worried about blue collar workers, it's the white collar workers that should really be nervous about this.
That's a good point. You need more carpenters and more plumbers, the guys to build the houses, not the guys that manage the assets. That's very true.
And fees will get compressed as well, which is great for investors and users, et cetera.
Yeah, great points. All right, Paul, I'm gonna get you the opportunity you've been waiting for here. Could you elaborate on the interoperability challenges in a multi-blockchain ecosystem and their implications for tokenized real estate projects?
Yes, I think I'll tackle this from a liquidity standpoint because I think it's a great place to start. And we know that liquidity is a huge topic, especially with the $1 trillion private equity debt, real estate, or whatever they estimate at $540 trillion. They estimate that at the end of the day, liquidity is king. We've talked about that quite a bit. There's been some really good points made. And to access that, that larger audience or a more addressable audience could be the difference between succeeding or not in this space. The biggest breakthrough that I've been doing a lot of R&D around recently was what's called CCIP, cross-chain interoperability. It's not blockchain, but it's a very secure bridge layer built by Chainlink. It offers kind of like an enterprise abstraction. So it facilitates the connection between banks, depository institutions, public blockchains, DeFi apps, and for me, the concept of that provides mass liquidity exposure while not worrying about any blockchain whatsoever. So Swift collaborated. I'm sure I feel like everybody probably knows this already, and just from a geek standpoint, I'm just digging into it quite a bit. But Swift collaborated with major financial institutions, Australian, New Zealand banking groups, BNY Mellon, Lloyd's. There's some digital exchanges there, depository trust and clearing companies. There's more than that. I just can't remember all of them. So effectively moving a digital asset cross-chain. So transferring like simulated tokenized assets took place. This was what they actually accomplished between two wallets, two different blockchains, and between a public and private network. So when we talk about liquidity and liquidity exposure and velocity of liquidity, I think that's could be a major breakthrough. So somebody gave a great comparison. So CCIP is like a value protocol, although it's not a blockchain protocol, a value layer, just like TCP/IP was, where it took internets to World Wide Web, moving around information. So at this point, they've been able to do Swift messaging, automate that. That was a big deal. I remember back in 2017-18, when I was in this space in a company in Bahamas, we were doing compliance as a service on chain, and Chainlink was like, yeah, we're gonna work with Swift and we're gonna automate all this stuff. And I think over the years, people were like, why hasn't this happened? It's just taken this long to put everything together. So the messaging around the Swift network is done. The movement of assets is done. Of course, Chainlink has a data validation layer as well. Anyhow, that for me, these are huge breakthroughs that we're investigating right now. I'd love to get anybody's comments. Everybody's following along with this, but I think it's quite a big deal.
Yeah, well, it creates that global marketplace once you can do that, right? You're no longer bound by the L1 or L2 you're working with. This allows you to transfer across those L1s and L2s And that is key. I mean, we've heard the L1s and L2s talk about interoperability all the time, but no one's done anything, and Chainlink's obviously taking the lead. So yeah, it's key.
I think from an investor standpoint, this is like the green flag, start the race. There's a mosaic of reasons why the time is now. I mean, investors, we need the money to move our apps and this technology into these types of platforms to create, this $1 trillion tokenized market. And capital is really needed, and capital is largely sitting on the sidelines right now because everyone's taken a punt in the last year, Web 2 and Web 3. But I think the race has started.
Yeah.
I just keep looking for the button that you have in Teams or Zoom where you just like have the hand clapping emoji. that's what this is what makes me excited, right? We've been talking a lot about different blockchain platforms being able to do what they do, right? We know what the technology is capable of, but the interoperability, hands down, is a game changer. So I'm so glad to, hear of all the updates. I'm sure the audience is too. Let's get into the next question here with Michael. What is the future of real estate ownership? What does it look like?
Well, I've got I don't talk about this too often with too many people because they look at me sometimes like I'm crazy. I see a new paradigm for home ownership and investing in real estate. I don't think people are going to necessarily want to own a home with the bank and have a certain percentage of the equity and be in debt. I think people are reaching the point of debt fatigue. Maybe I'm overreading it, but I do feel there's a level of debt fatigue. Everything's in debt. Municipal governments, federal governments, your grandmother, everyone's in debt. And I do think people want to own stuff and own it outright and have no debt associated with it. So I do see this model where people could own 30% of a home, have the residential rights as they would with our sort of platform, and then have co-owners. And then maybe over time, with the money they're saving, they can invest that money and build wealth through other means. And then they could also potentially own 30% of another home. Especially when you start looking at, the younger demographics, millennials and Gen Zers, the idea of having multiple residences in 2 different cities and being very mobile in terms of your work could be something that's very appealing to them. But I do think at the end of the day, I do see that paradigm shift happening where, you're better off owning a percentage without debt than percentage with debt. It's been a big burden. People make decisions based on those mortgage payments and, whether or not you're sending your kids to that school, whether or not you're going to go on that holiday, whether or not you're going to make that investment. Those are big life changes, big life decisions. And without that debt and that treadmill of debt, I think we're going to be able to shift the economy in some respects because we're creating more investable cash, essentially, and also create new opportunities for investors to invest in a new asset class, or not a new asset class, but an asset class that's more easily accessible than it has been. As Andrew pointed out, it's not been very accessible to investors. So that's where I see it going. I've talked to this about some people, and they think that that's crazy, that people are still going to want to go into debt and have a mortgage, which is fine. I'm sure that's still going to exist to some extent. But I do see that ownership structure and that investment structure changing in the decades to come.
Any other responses to that question?
I'm worried that Michael's confusing consumption with investment. The idea that people might want to have access to 2 or 3 homes. I can get that, but is that investment or is it consumption? Is this something that's just purely a financial investment, or is it the holiday home idea is a classic example of this sort of bridge. I've got a sort of an alternative vision of a beautiful future, which is very European, and you'll hate this because it's so un-American, which is based on socialism, as you can imagine. But the idea that we might use this sort of technology ultimately to invest in our own communities and to invest in assets that are needed by people. So the idea that if I could buy a digital token in some affordable housing in Africa, for example, I'd do it like a shot. Instead of giving £10 a month to save the children, I would very, very happily buy tokens in some African affordable housing. Closer to home, there's some great ideas coming out of, it'd have to be California, wouldn't it? It would have to be California. But the idea that you can buy digital tokens in your own community, so that the community might use the money to build a hospital, and you might get a revenue share from the hospital facility, or at a much lower facility, at a much lower level, buying a share in your own coffee shop, getting a utility token combined with a security token. There's just so many wonderful applications that I can see down the road. I think, Michael, the whole business plan of democratizing residential property, I think it's absolutely beautiful from the equity release side. I think the work needs to be done on the buyer side. I think, what is the case for people putting money into these things? That's the bit that I'm not completely sold on yet.
Yeah, I mean, a case has to be built. It's not an unsolvable problem. In my opinion, it's a solvable problem. And at the end of the day, why will people invest in something? They want to invest in it because they want a return on their investment. What's that return? What's their thesis? Do they want 7-10% with some stability? Are they higher risk? Are they going to invest in something that's much more lucrative potentially, but they could also lose their shirt? So I think there's a niche there of the type of investor based on their investment thesis, their age, if they're going to invest in an asset like this. And then again, there's the institutional investors like pension funds, and also, as Don mentioned, financial advisors who control trillions of dollars of assets on an annualized basis, advising their clients to, hey, you got a beautiful home in Alabama, but it's not appreciating at the same rate as homes in, Milan or Florida or Sydney, Australia. Maybe you should diversify that part of your portfolio and invest in those homes in those markets and still retain the residence and ownership of your current home, but sell some of it to investors.
Yeah, I mean, I love what Andrew said. I mean, I just, Rome wasn't built in a day. It'll happen. It'll just give it time, like everything else. I mean, nobody ever thought a smartphone would exist, and then Steve Jobs created it. And we've all, I'm certain, have bought homes and stuff from a consumption perspective, and I can't wait until the day where I don't have to deal with Chicago title or anything like that, and it just gets simpler. My costs go down. We use real estate in one of our presentations as it relates to explaining what the blockchain is. So A1 is the buyer, B1 is the deed, and C1 is the seller, and eliminating the mounds of paperwork and time that's required with all these intermediaries. And it'll just, when the conditions are met in the smart contract, it'll get done. And we're excited for that to happen.
I think it's really much a mindset in ownership, redefining what actually ownership means. And maybe it's mindset. You said age a minute ago. So, to unlock like economic utility of an asset, that's great. We can understand that, but do people really understand it? Can we shift the mindset where we've given up our identities and given up all of our data, and now we're redefining ownership of a human and what that actually means? And it's more about, I think, organization, governance, economic models, and education. Not to keep harping on education, but that's a big part of it.
Yeah. Well, Andrew, I was relieved you didn't say we will own nothing but be very happy leasing it, which is come out of Europe and I'm like, well, if people are going to want to own things, they're not going to want to lease everything for the rest of their lives. I don't believe in that at all. But there are certain people that do. And that to me is not something that, that means someone else owns the asset and someone else is getting rich. So I love the idea of, I in a second, if I could invest in a local coffee roastery, I love coffee, I would do that in a second. I just think stuff like that would be amazing. Being able to invest back into your community. Wow. I do see that happening. It's just a question of when.
I'm with you on that. I've got 3 kids, and the first one came to me and said he wanted to buy a house. He didn't want to rent. So of course, I've got to give him some money. Then the second one does, when house prices have gone up 50%, I've got to do that. Then my daughter comes when house prices have doubled. I've got to do that. Ultimately, we do believe in the ownership model. There's no doubt about that. And last week, the local youth hostel in my village came up for sale, and there was a Save the Youth Hostel campaign.
Yeah.
And just imagine if we had a digital tokenized community market, we would have solved the problem immediately.
Yeah.
But it took us so long to write to everybody, say, would you invest £50,000? How would you do this? We had lawyers talking about, is it an LLP? Is it an LLC? How do we do this? How do people sell their stuff? You just can't achieve these things, but with a blockchain enabled app, we would solve these problems immediately.
I know, it's very cool. The future from that perspective is going to be really interesting, for sure.
Well, I thank all of you for answering that last question in some way, shape, or form. And I 100% hands down think the community standpoint is lucrative. Those who are not working on it, maybe Michael, you're thinking about it down the road. I think we should all think about, because we all have to live, work, and play in our communities. If we can think of some way to invest in our communities in a smarter way using the technology that's available, why not?
Yeah. Yeah.
Okay,
Sure.
so we have some questions from the community to the panelists. I want us to answer these questions. Some of these we've touched on already, but no specific person has to answer these questions, but I will throw these three at you. First one is, what do you see as the single most significant advantage of using blockchain and tokenization in real estate investing? And that's from Thomas Helfrich.
Come on, Don.
The single best advantage, is that the question?
Single most significant advantage of using blockchain and tokenization in real estate investing.
Well, again, I think it's a couple fold in terms of democratization. Like, again, people have not had the ability to invest in various forms of real estate. So there was a building in Dubai that was tokenized. There's the St. Regis Hotel in Aspen that's been tokenized.
Yeah.
There's stuff here where I live in Atlanta that's been tokenized. So I think the democratization is pretty important. I also think that, again, the fee compression, like it's happening in the credit card business too, where like, do we need this? And doesn't blockchain solve a lot of this? And again, I'm just talking right now, real estate. There's a lot of other areas in which blockchain is enormously beneficial. But again, the fee compression and the access, which allows, again, modern portfolio theory, a diversified portfolio usually results in lower volatility and likely higher expected returns. So again, democratization, lower fees.
All right. Anybody else want to take a stab? Okay, we got some support on the response. Okay, let's move on to the next question. The vast majority of people's wealth, 95% plus, is locked in their homes. What is the macroeconomic risk of not allowing people to easily and cost effectively access their hard-earned equity? And that's from George.
Andrew, you're laughing at that one.
What's the risk of having your money locked up? Is that the question?
Yeah, essentially.
Survival right now in today's world.
Yeah.
You need to be able to access it to survive. Everybody's looking for different needs.
I've got a contrary view, I'm afraid. I think we can overrate liquidity. So people don't want to sell their house in a day, or they don't want to buy a house in a day. They want longer to think about it. And the reason that house prices are reasonably stable in the short run is because they're illiquid. If you've got to be very careful what you wish for. If you create a trading platform where you can sell your house instantaneously, then imagine what would have happened in 2008 in the US to house prices. If we had to buy and sell all the houses in the US every day, they'd be massively volatile, just like equities. So I think people need to be a bit careful about this. We want all the benefits of real estate stability, and the more liquidity you throw at it, the more you challenge that. So I think we just need to be a bit careful about that one.
You also have to move. So in California, you can sell a house in a day, but then you're gonna take the money and you got to move someplace else. And what's going to make certain that you're going to be able to afford the place you're moving to? So that's another factor.
Well, you can. Sorry, Michael. Go on.
No, I also find real estate's a little less speculative in the sense that it's based on a solid, real physical asset. It's not a technology company. It's not another element like that where there's a lot more volatility and uncertainty, and there's human factor involved where there's people running the company and could essentially run it into the ground. And make bad decisions. You still have that asset there. So I still think by creating greater liquidity, you may create some more volatility, but I still think people know that there's something solid there at the end of the day. But could it be like a commodity where you get a little more volatility like you do in gold? It can go up and down a little more quicker and, up and down quicker during an interim period. that could happen with real estate too. Well, I guess we'll have to see from that perspective. I think the risk, though, of not giving people access to their equity, there is a serious problem there. If people need to access their equity and they're paying through the nose for it, like in a reverse mortgage, like reverse mortgages in the States can be absolutely brutal. You are causing an economic hardship on people who own that asset and should be allowed to access that equity without burdenous costs. So there is an economic downside to not allowing people to access their equity.
I agree with that, Brittany, Michael. I really do agree with that. And in some jurisdictions, there are huge tax advantages as well through your proposal. For example, in the UK, we can avoid inheritance tax, we can avoid capital gains tax, and we can avoid a real estate transactions tax by equity release. This is just beautiful.
Yeah, no, very true.
All right, last question. With billions being invested in AI, how will this technology impact blockchain and real estate investing? This is from an anonymous person.
Yeah, it's a good question.
Maybe it's from
Automation.
ChatGPT.
Automation. I mean, maybe Michael, you answering that. You talked a little bit about how you want to put that into your platform. But I mean, I think you talked.
Yeah,
I mean, it's a big deal.
Yeah, I mean, AI could actually make smart contracts smart. We use the term smart contract rather loosely, but it could make smart contracts smart. It can be used for better data analysis and present better forecasting. How it could affect the chain itself, I'm probably not the best person to answer that. How it's going to affect real estate, it's a tough question, because is it going to provide the right analysis of the marketplace, or is it going to be used in a nefarious way? It's very, very hard to tell right now. Could it be used to manipulate markets as well? And that goes across the board. It's such early stage with AI. It's like this double-edged sword. It could be a golden era for humanity, followed by a disastrous era for humanity. So it's very, very hard to tell how AI is going to impact these things. There are definitely concerns, and it could be good or it could be bad. So it's hard to tell. I do think, though, in the interim, there's some great applications for AI, but we're still generative AI. We still control it, right? So when we move to the next stages of AI, where we start losing control on AI, that's where you've got to be really worried about. But I'm getting way speculative, way ahead. We could all be dead by then. So who knows?
I mean, some really tangible responses to this is, I mean, to your point about data review and summarization and forecasting, any kind of data that generative AI analyzes, you can output any kind of report, existing conditions, and any kind of graphic capability that you like. Back to your point about smart contracts, right? There's the ability for true clauses, the way the obligations and engagement that is in a contract is articulated. It can literally, as a large language model, translate that into code, right? That's something that's so simple to do. It's an avenue for those who are capable with coding capabilities, and those who'd like to learn, to start producing products that will actually support the development of tech that can actually do what we're talking about from an interoperability standpoint, tied to the actual stages of transaction within blockchain. And I think we're not far from that. There's so much capability. I mean, we create chatbots. We've created maybe about 10 this year alone. And it's with some simple light coding, doing exactly what I'm describing, having some sort of business plan, really translate that into a code, right? And you could put that in a website, you could put that into a chatbot, you can put that into so many things. And I think it's going to make things a little bit simpler. How does that specifically impact real estate investing? I don't think that there are limitations. I think it's just a matter of what your creativity will hold. AI is just it's an advisor, if you will. You need to have domain knowledge in order to direct it. So that's just my 2 cents on that one.
I think translating legal jargon And if any of the smart contract carries that, there are human readable Ricardian contracts right now that will take a smart contract and translate it over. They're not efficient because they do lack things like AI to help translate it for the layman person.
Yeah.
You don't get caught in a deal that doesn't work for you. I think it's challenging for a lot of people. And if you think of from a retail investor standpoint, they largely don't, they largely just click yes to everything. We all do in our lives for the most part. And I think that translation could help perhaps identify some of the risk that's involved in that transaction. And you get a nice human readable smart contract there.
That's a great point, Paul.
Yeah, that's a good point.
All right, with that, we are wrapped up with all the questions. I want to thank everyone for listening to the Vesta Equity Podcast. Everyone have a great day.